Imagine this. You just landed in Tokyo. You pull out your wallet, hand over a crisp $100 bill, and the cashier slides back a stack of bills that looks like you just robbed a bank. Over 14,000 yen. You're standing there thinking, wait, am I rich now? Did I just become wealthy by stepping off a plane? And then you walk into a convenience store, grab a bottle of water, and the price tag says $150. You panic for a second. $150 for water? Then you remember, oh, right, that's like $1. You breathe again. But here's what nobody ever stops to ask. Why? Why does $1 become 14,000 of something else? Why is your money worth more the moment you cross a border? Why can some countries print their currency and watch it collapse, while others print billions and nothing happens? This isn't just economics trivia. This is one of the most powerful forces shaping your life right now. The price of everything you buy, every job that exists or disappears, every financial crisis you've ever heard of. And most people have absolutely no idea how it works. So today, Max is going to break it all down. No textbook language, no boring charts, just the raw, honest truth about why currencies have different values and why it matters way more than you think. Stay with me, because by the end of this video, you're never going to look at money the same way again. What is a currency? Really? Let's start at the very beginning because most people get this wrong. A currency isn't money in the deep sense. It's not gold, it's not silver, it's not something with intrinsic value sitting in a vault. A currency is a promise. That's literally it. When you hold a dollar bill, you're holding a piece of paper that works because everyone agrees it works. The moment people stop agreeing, the moment trust breaks, that paper becomes worthless. Think about that for a second. The entire global financial system, the trillions of dollars moving around the planet, every single day is built on collective belief. It's the world's biggest social contract. Now here's where it gets interesting. Not all promises are created equal, and not all trust is equal either. When you hold a US dollar, you're holding the promise of the most powerful economy on the planet, the country that accounts for roughly 25% of global GDP. The country whose military, institutions, and economic history have made it the default safe haven for literally every investor, government, and central bank on Earth. When you hold the Zimbabwean dollar, well, we'll get to that story. And it's not pretty. The point is this. The value of a currency is a direct reflection of how much the world trusts the country behind it. Trust is high, currency is strong. Trust collapses, currency collapses. Everything else we're going to talk about today is just the mechanism behind that trust. Supply and demand. But not the way you were taught. Okay, you've probably heard this before. Supply and demand. Currencies are just like any other product. If everyone wants dollars, the dollar gets more expensive. If nobody wants the Argentine peso, it becomes cheaper. But what actually drives demand for a currency? This is where it gets real. The number one driver is trade. Every time a country sells something to the world, oil, cars, electronics, soybeans, whatever, the buyer needs to pay in the seller's currency. So if Germany is selling BMWs to the United States, at some point someone needs to convert dollars into euros to pay for those cars. That creates demand for euros. Demand goes up, the euro strengthens. Now flip it. If a country imports way more than it exports, it's constantly sending its own currency out and bringing foreign currency in. More of its currency is floating around the world, supply increases, and the value drops. This is called the trade balance, and it's one of the most fundamental forces behind currency values. But trade is just one piece. The second big driver is investment. Where do the world's richest individuals, biggest corporations, and most powerful governments park their money? Wherever it's safe and growing. If the US stock market is booming, foreign investors pour money in. And to do that, they need dollars. That buying pressure pushes the dollar up. If a country looks unstable, risky, or poorly managed, capital flees. Investors sell that currency and run. The currency tanks. This is why political instability is so devastating for a currency. It's not just symbolic. The moment a country looks shaky, billions of dollars in investment can vanish overnight. And when investors sell, they're literally dumping the currency on the market, flooding supply while demand dries up. The math is brutal. The inflation time bomb. Now, let's talk about the thing that destroys more currencies than anything else. Inflation. Here's the simple version. Every country's central bank, the Federal Reserve in the US, the European Central Bank in Europe, the Bank of Japan, controls how much money exists in the economy. When they print more money, more units of currency are chasing the same amount of goods and services. Prices go up. Each individual unit of currency buys less. That's inflation. And here's the critical link to currency value. If your currency buys less domestically, it also buys less internationally. Foreigners aren't going to hold your currency if it's slowly melting in value. They sell it. Supply goes up, value goes down. Inflation and currency weakness feed each other in a vicious cycle. Now let's look at what happens when this goes catastrophically wrong. Venezuela, one of the most oil-rich countries on the planet. In the early 2000s, the Venezuelan bolivar was a normal currency in a somewhat functioning economy. Then the government started spending way beyond its means. It needed to fund social programs, it was mismanaging oil revenues, and it had massive debt obligations. So it did what desperate governments do. It printed money, lots of it. At first, it seemed fine, but inflation crept in, then it ran, then it sprinted. By 2018, Venezuela was experiencing hyperinflation at over 1,000,000% per year. That's not a typo. 1,000,000%. A bag of rice that cost 1 bolivar one year cost 1,000,000 bolivars the next. People were wheeling cash in wheelbarrows just to buy groceries. The currency became so worthless that Venezuelans started using dollar bills as napkins, not as a joke, but because it was literally more practical. The bolivar didn't fail because Venezuela ran out of oil. It failed because trust evaporated, and once trust is gone, no amount of printing can bring it back. Interest rates. The secret weapon of central banks. Here's something most people never connect to currency values, but it's absolutely massive. Interest rates. When a country's central bank raises interest rates, something very powerful happens. Suddenly, holding that country's currency becomes more attractive. Why? Because you can park your money in that country's bonds or savings accounts and earn a higher return. Investors from around the world start moving money there. Demand for that currency spikes. The currency strengthens. Lower rates, and the opposite happens. Money flows out looking for better returns elsewhere. The currency weakens. This is why every single Federal Reserve announcement moves markets globally. When the Fed raises rates, the dollar typically strengthens, sometimes dramatically, because capital floods into dollar-denominated assets. Emerging market currencies often take a hit at the same time, because money that was sitting in Brazil or Indonesia or South Africa suddenly looks less attractive compared to safer, higher-yielding US assets. It's a giant game of musical chairs, and the Fed is the one controlling the music. This dynamic also explains something that confuses a lot of people. Why do some countries with relatively small economies have surprisingly strong currencies? Because they have high interest rates, stable institutions, and attract capital. And why do some larger economies have weaker currencies? Often because their rates are low, their institutions are weak, or their growth prospects look uncertain. Currency strength isn't about size, it's about attractiveness. Think of currencies like cities. Some cities attract everyone. Others can't keep people from leaving, regardless of how big they are. The dollar's unfair advantage. All right, now we need to talk about the elephant in the room, the US dollar. The dollar isn't just a strong currency. It's in a completely different category from everything else on the planet. And understanding why is absolutely key to understanding the modern financial world. After World War II, the world needed a new financial system. Europe was in ruins. Asia was devastated. The US was the last major economy still standing with its infrastructure intact. In 1944, at a conference in Bretton Woods, New Hampshire, the world essentially agreed to make the US dollar the global reserve currency. The currency that all international trade would be priced in, and that all central banks would hold as their primary reserve. Oil gets bought and sold in dollars. Most commodities are priced in dollars. When Thailand buys oil from Saudi Arabia, they do it in dollars, even though neither country uses dollars domestically. When a Vietnamese company takes out an international loan, it's almost certainly in dollars. The dollar is the universal language of global finance. This gives the United States a superpower that no other country has. It's called the exorbitant privilege. Because everyone in the world needs dollars to do business, there's a constant structural demand for the dollar regardless of what the US economy is doing. The US can run massive deficits, borrow at lower interest rates, and export inflation in ways that would absolutely destroy any other currency. Is this fair? Absolutely not. France's finance minister in the 1960s famously called it an exorbitant privilege, and he was furious about it. But fair or not, it's reality. And it's one of the biggest reasons why the dollar has remained dominant for over 80 years, despite every prediction that it would eventually be replaced. Why the Japanese? Yen is both weak and respected. Let's zoom in on a fascinating case study that breaks a lot of assumptions. Japan. Japan is the third largest economy in the world. It has some of the most advanced technology on the planet. Its companies, Toyota, Sony, Nintendo, Panasonic, are global giants. And yet the yen trades at over 140 to the dollar. By simple exchange rate logic, that sounds weak. So what's going on? Japan has kept interest rates near zero, and sometimes even negative, for decades. Why? Because Japan has been fighting deflation, not inflation. Their economy aged rapidly, growth slowed, and they needed to keep borrowing cheap to stimulate spending. Low interest rates mean low demand for the yen from international investors. Why park your money in Japan earning nothing when you can earn 5% in the US? So capital flows out, and the yen stays weak relative to the dollar. But here's the thing. Japan's currency situation is completely stable and intentional. They're not Venezuela. The yen is a trusted, liquid, globally held currency. Its weakness is a policy choice, not a crisis. Japan is actually one of the world's largest creditors. It owns more foreign assets than almost any other nation. This is the crucial distinction. A weak currency isn't always a sign of failure. Sometimes it's a deliberate strategy to make exports more competitive, to stimulate the economy, or to manage debt levels. The yen is weak by design. The bolivar was weak by disaster. The difference is control, intention, and institutional trust. What happens when a currency collapses? We've touched on Venezuela. Let's go deeper into what an actual currency collapse looks like, because this isn't just history. This is happening somewhere in the world right now, and it could theoretically happen anywhere. A currency collapse usually follows a predictable pattern. First, the government overspends and accumulates debt it can't service through normal taxation. Second, it starts printing money to fill the gap. Third, inflation rises and people start losing confidence. Fourth, they convert their savings into foreign currency or hard assets, gold, real estate, anything that holds value. Fifth, this selling pressure accelerates the currency's decline. Sixth, the government prints even more to try to keep up. And then the spiral becomes unstoppable. What's devastating about this process is how it wipes out the middle class. Rich people have assets, property, stocks, foreign accounts that hold value or even benefit from inflation. Poor people don't have savings to lose, but the middle class, their savings, their pensions, their salaries, all denominated in the collapsing currency, all evaporating in real time. A lifetime of work gone in months. Argentina has gone through this cycle multiple times. Lebanon is living through a version of it right now. Turkey has been flirting with the edge of it for years. These aren't exotic, far-off stories. They're warnings. And here's the uncomfortable truth. No currency is immune. Every fiat currency in history has eventually faced serious challenges. The The ones that survive do so through disciplined institutions, credible central banks, and the constant maintenance of trust. The moment that trust is taken for granted, the moment governments start treating the printing press as a solution, the clock starts ticking. How exchange rates actually get set. Every day, okay, so we've covered the big forces, but you might be wondering, practically speaking, how does an exchange rate get determined every single morning? The answer is the foreign exchange market, or forex. It's the largest financial market in the world by a massive margin. Over $7.5 trillion traded every single day, more than all the world's stock markets combined. Forex never sleeps. It runs 24 hours a day, 5 days a week, across financial centers in Sydney, Tokyo, London, and New York. Every second, banks, hedge funds, corporations, governments, and individual traders are buying and selling currencies based on their expectations about all the factors we've discussed: inflation, interest rates, trade data, political stability, economic growth. The exchange rate you see on Google right now is essentially the market's real-time consensus on the relative value of two economies. It's millions of smart, self-interested actors constantly updating their bets on the future. Some countries let their currencies float freely in this market. Others peg their currency to the dollar or another anchor currency, fixing the exchange rate artificially. China does a managed version of this. They let the yuan move, but within a tightly controlled range, constantly intervening to prevent moves that might hurt their export competitiveness or financial stability. Pegging can provide stability, but it comes with a huge risk. If the peg becomes unsustainable, if the real economic fundamentals diverge too far from the fixed rate, it breaks catastrophically. In 1992, George Soros famously bet against the British pound's peg to European currencies, forced the Bank of England to break it, and made over $1 billion in a single day. One man broke a currency. That's how much power market forces have when reality and policy diverge. Why this all matters for your life. Right now. All right, let's bring this home. Because maybe you're thinking, this is fascinating, but I live in one country. I earn in one currency. Why should I care about any of this? Here's why. Every time you buy something imported, a phone, a piece of clothing, a car, its price was shaped by exchange rates. When your currency is strong, imports are cheap. When it weakens, everything foreign gets more expensive. Inflation often has a currency component that nobody talks about. If you have savings, you should be thinking about currency risk. Keeping 100% of your wealth in one currency means you're fully exposed to whatever happens to that country's economy, politics, and monetary policy. Wealthy people diversify across currencies and assets for a reason. If you travel, if you freelance internationally, if you have any connection to the global economy, understanding exchange rates isn't optional anymore. It's financial literacy for the 21st century. And on the biggest scale, the competition between the dollar, the euro, the yuan, and the emerging digital currencies isn't just geopolitics. It's a battle over who gets the exorbitant privilege next, who gets to print the world's money, who gets to set the rules. The outcome of that battle will shape the next century of human prosperity and conflict. The bottom line. So here's what Max wants you to take away from all of this. Money isn't real in the way we think it is. It's trust. It's agreement. It's a collective story we tell each other, and like all stories, it can change. Currency values are determined by the constant interplay of supply and demand, inflation, interest rates, political stability, trade flows, investment confidence, and deep structural forces like reserve currency status. Some currencies are strong because they've earned trust over generations. Others are weak because that trust was broken. Sometimes by negligence, sometimes by desperation, sometimes by corruption. Understanding this doesn't just make you smarter in conversations. It makes you better at protecting yourself. It makes you ask better questions about the economy you live in, the savings you're building, the investments you're making. Because here's the cold truth. Governments will always be tempted to print their way out of problems. And the cost of that temptation is always paid by the people holding the currency. The next time someone hands you a bill in any currency, and remember, you're not holding money. You're holding a promise, and it's worth exactly as much as people believe it is. Tell me what topic you want me to cover for the next video. See you.